This is Mark Item with HONU Trading with weekly review for the week of June 5th, 2023. First, our disclaimers. Education only. Know your time frame and risk tolerance. As always, job one is risk management. Follow me on Twitter at HONU Management, HONU MGMT. And if you find this valuable, take a moment to like and subscribe. Well, wow, what a difference a week, or really just Friday, makes. For the last couple of weeks, we've talked about the concept that the market knows about all the bricks in the wall of worry that a bull market climbs. Sticky inflation, Fed raising interest rates, problems with banks, housing unaffordability, political strife, war in Ukraine, yada, yada, yada. Poor breadth, everything. But one other thing that I want to talk about is the why a move happens doesn't matter. In fact, I did a whole video on that. I'll put a link in the description. That video tracks what happened with Viacom as Archegos Capital built a large leveraged position over a few months and then had to unwind it in literally 3 or 4 days. And we didn't find out until well after Viacom had not only rallied but collapsed what had happened. So again, the why something happens doesn't matter. You always see the pundits trying to explain, well, the market's up today because of A, B, C, D, E, or the market's down today because of, hey, forget it. The why doesn't matter. We had a very powerful move. What drove it? Irrelevant. So the week in review, are we unstoppable now? Well, definitely maybe. The Biggies are still running the show, although we had huge improvement on Friday. Breadth actually was negative on the week in terms of new highs versus new lows. We've talked about our risk on, risk off indicator. Hat tip to Chris at Chiavaco Capital for that one. I'd say we're probably back to risk on that. We've also talked about for a few weeks, are the financials out of the woods yet? I'd say they're right at the edge of the forest. And finally, we have a couple of contestants for our earnings game, jacked or whacked. So here we have the rip snorting bull. This is the guy we wanted for a while, and he showed up on Friday. Now, is the market unstoppable like a T-Rex with arm extenders? Yeah, I don't know. So let's take a look at the week in review. Remember, Monday was a holiday. Tuesday, we gapped up slightly and then failed all the way into basically lunchtime on Wednesday. Then rallied, fell a little bit at the end of the day, beginning of the next day. Fairly strong rally to break out above the 420 and close above that 420 level that's been resistance for over a year. And then Friday, pretty much off to the races. Now that 415 to 420 we've been talking about for a while, that's been resistance for over a year. Now that it's been broken, that really should be support. So for the week, the markets were up 1.8 as measured by SPY, and that's one of the better weeks we've had. Now, I know it might be summer, but this bear is in hibernation. But the breadth, yeah, kind of weird. Monday's a holiday, Tuesday plus 10. Wednesday was a down day, minus 186. But Thursday was a pretty positive day, minus 61. But Friday, that really changed the tone of the market. Didn't do enough to pull us up for the week, still minus 70 versus plus 57 last week. Talked about this one for a while, the relative strength of the equal weighted indexes, the RSP versus SPY, equal weighted Qs versus the cap weighted Qs. And those aren't really a lot better, but there's significant improvement. Still not out of the woods yet, still a downtrend, but significant improvement on Friday in the MDY, which is equal weighted mid caps to SPY, and the equal weighted small caps to SPY. Friday, the heat map definitely had a St. Patrick's Day theme to it. Lots of green, and for the week, even more green. But again, look at all the big guys, Microsoft, Apple, Nvidia, Google, Meta, Amazon. Tesla was up on the week. So the big guys, but look at all the other green in the small caps, particularly in industrials, financials, some of the beaten down sectors. Our risk on, risk off indicator is probably back to risk on. This compares the relative performance of the S&P 1500 composite, which is the 500 large, 400 mid, and 600 small, all in one index, relative to the performance of the 3 to 7 year Treasury bond ETF. What this gives us is periods of time where it's indecisive, and we've just finished one of those, but very clearly risk on and risk off moves. So are we completely out of the woods yet? No, but all these things are going in the same direction. Financials. I think they've crept to the edge of the forest. I think they're right at the edge of the forest. First, let's take a bigger picture view with XLF going back over a decade. This is to the 2008 financial crisis. And you see that 30 to 31 level I've been harping on for quite some time. And now this really shows why that's important. It was resistance in 2007 and 8, again in 18, and again just before COVID. And then finally broke through that. Resistance, once broken, should be support, and that's now been tested 3 different times. So when you look in and zoom into a daily basis, we still have a series of lower highs, but we also have 2 higher lows and are just on the verge of breaking to a higher high in the XLF, probably meaning that uptrend can resume. On the bigger banks, that's actually a little more encouraging. We actually do have a slightly higher high, particularly on a closing basis, and right on the verge of getting one with the regional banks, which is where most of the trouble has been. Earnings coming up next week, not a lot to see. I don't see any Dow stocks or major S&P or QQQ stocks. We do have NEO on Friday. And then for our earnings, jacked or whacked, we're going to start with a whacked. And I want to illustrate a couple of points in addition to significant moves on earnings. Here's a stock, Advanced Auto Parts, that only had a price earnings ratio of 7. Now, all things being equal, yes, we'd love to have lower valuations than higher, but this has been a low valuation for quite some time, and it has been trending down for quite some time. It has been below a declining 200-day moving average for over 9 months. It's below a even steeper declining 50-day moving average. And if you look out to the weekly time frame, this set a peak back in December of 2021. So it's been in a downtrend for over a year. Contrast that with our earnings jacked, which is MongoDB, and that has a PE of 260. Now, it has done some work in the 200-day range. One other thing I wanted to go back to on the Advanced Auto Parts is that look at the revenue growth, or the lack thereof. You've got 1%, 1%, 3%, 1%. Contrast that to MDB, where you have 53%, 47%, 38%, 29%. Now, those are powerful sales growth numbers. And when you look at this on a longer term basis, MDB had a strong uptrend, peaked in December of 2021, fell throughout 2022, put in a stage 1 base and broke out of that before earnings. So to recap, let's talk about, again, what a difference a day makes. We'll see more in the coming weeks whether that sticks, but I'm really encouraged by the strong performance of the small and mid caps. The market knows about all the bricks in the wall of worry and is climbing it anyway. Why does it matter? Bread, new highs, new lows, still needs to do some work. We're probably back to risk on. Financials might not be out of the woods, but they're at the edge of the forest. So going into next week, remember to manage risk, trade well, and as my buddy HONU always says, small losers win.